Hello, my name is Brother Roten. I am a professor in the Business Management Department at Brigham Young University, Idaho, and I wanted to create a little screencast to help students understand the basic layout of financial statements and the purpose of financial statements. Now, this screencast is designed as an introductory module for students who may not have had any experience or exposure with financial statements. In order to understand financial statements, it may be helpful to understand why they're required. After the stock market crash of 1929, the Securities and Exchange Commission basically required all publicly traded companies to file financial statements so that the public would understand what the financial health was of the companies that they were investing in. Now, the Securities and Exchange Commission basically requires these companies to follow generally accepted accounting principles, or GAAP, as they file these financial statements. And the generally accepted accounting principles can change from time to time, but this screencast will basically illustrate what the current, as of 2015, the current generally accepted accounting principles are in regards to financial statements. So all publicly traded companies are required to file 4 basic financial statements. You have the income statement, the balance sheet, the cash flow statement, and the statement of shareholders' equity. Now in this video, we're going to go over the income statement and the balance sheet more in depth. We'll briefly cover the cash flow statement, but the statement of shareholders' equity is probably better left for your advanced accounting courses, because you probably won't be dealing with much of the information that's in here unless you're more of an advanced financial analyst. But most people are very familiar, or need to be familiar, with the income statement and the balance sheet. Now, financial statements are basically a record of financial activity that has happened over a certain period of time. We're going to start out with the income statement. The income statement layout is basically your revenue minus expenses. Now, what that means is revenue is all the money that a company or an organization brings in, less expenses they incurred to arrive at net income. Now, the net income statement may be broken out a little bit more expanded. An expanded version starts out with revenue, and then it may list costs of goods sold. This is the cost of the products or services that they're selling, to come up with either a gross profit number or a contribution margin number, less their fixed expense or the rest of their operating expenses, to come up with operating income. And then finally you subtract out interest and income taxes to come up with net income. So if you were running a lemonade stand, you'd have revenue from selling lemonade minus the cost of the lemonade to get your gross profit. Now your fixed expenses could be things like if you had to buy a table or a pitcher, because you're using those, they're fixed. It's over time to come up with operating income, minus interest and income taxes to come up with net income. That's the basic layout of the income statement. Now, one other thing on the income statement. The income statement is what we call a temporary statement. What that means is it's over a period of time, and then it is usually reset to zero. So you have an income statement for, say, a month, or an income statement for, say, a quarter or for a year, and it measures the revenue and expenses for that time period, but then it's reset to zero. The balance sheet, the layout of the balance sheet is assets equals liabilities plus equity. This must always stay in balance. Now the balance sheet is basically a financial statement that shows what the company has on hand, what their assets are, minus, or it needs to equal, either what they borrowed or what people have put into the company. This is the balance sheet. Some examples of assets would be like cash, inventory, buildings, land. These are all assets that a company has. Liabilities may be amounts they owe to the bank, amounts they borrowed from different vendors. And then equity is the owner's equity. In fact, I probably should change this to owner's equity, because this actually represents the amount. Let's see here. Well, in any event, this is owner's equity. Let's leave it at equity. This is the amount that basically either the owners are contributed, and it also represents the accumulation of all retained earnings. I'll come back to this in a minute. Now the balance sheet is actually a permanent financial statement. It never goes away. but it's only good for a certain date in time. So usually you'll see the balance sheets as of a certain date, and it just keeps going and going and going, but it changes every day as different transactions occur. Now the cash flow statement actually helps reconcile your net income to cash, because some companies, even though they may produce income, they spend all their cash or they run out of cash. And so this helps you understand the cash flow from a company. And then the final statement is the statement of shareholders' equity. Basically, this is beginning retained earnings plus or minus some equity adjustments equals ending retained earnings. This helps analyze the different entries and adjustments that are going on in this statement of shareholders' equity. Now, just a couple of nuances going back up to the income statement. So you keep track of all your income, and then what happens is at the end of the reporting period, your net income is actually posted into equity. So you can think of the income statement as kind of a subset of equity. Down in here, I probably should do a little box, but in any event, the net income, in fact, I'll just go ahead and copy this over here so you can see that, net income is going to actually be kind of a piece of equity, and that rolls into your retained earnings. So as the net income statement closes out, it adjusts equity, and that's how everything stays in balance. Your balance sheet should and must always balance. Assets must always equal liabilities plus equity, right after your net income has been posted for the period. Now let's look at a couple of examples. Here is the income statement for Apple. Some of you have heard of Apple Incorporated, and probably one of the first things you notice is that they don't call it the income statement. They actually call it consolidated statement of operations. It's quite common for companies to use different terminologies for the income statement. Sometimes they call it statement of operations, statement of ops, the P&L. P&L actually stands for profit and loss statement. That's kind of an older term, but a lot of people still use P&L, ops, what's the budget, line item, things like that. They're all talking about the income statement. So the first thing you want to look at with Apple's income statement is that you can see it is for the year. This income statement goes for a full year, and Apple is on a fiscal year. In this year, 2014, it ended on September 27, 2014. So for a year, this is their income. Starts out with net sales, and it has a cost of sales, and then they have their gross margin, or sometimes called gross profit. This shows the gross profit out of their sales minus their costs of goods sold. Then you subtract out their operating expenses to come up with their operating income. In fact, I'll go ahead and just highlight some of these terms. And then you subtract out taxes and other interest and expense items to come up with net income. So this is the layout of the income statement for Apple, and you can see that it is in millions. So for the year ending in September 27, 2014, Apple had sales of $182,795,000,000. This is their cost of goods sold. Here's their operating income, $52,503,000,000. Their net income was $39,510,000,000. So that's their income statement. Now we're going to scroll down past a couple of statements. These are supplemental statements, now down to their balance sheet. Here's their balance sheet, and this is as of a certain date. It's as of this day when the balance sheet closed, at the end of the balance sheet. And you can see they list out assets first, and here's all their assets. Apple has total assets of $239,839,000,000. And their total liabilities and equity equals their assets, same amount. And then retained earnings in here includes the posting of net income into the retained earnings. Here's their liability section right here, and here's their equity section. Now in this case, they don't call it owner's equity, they call it shareholders' equity. Whether it's equity, shareholders' equity, stockholders' equity, or owner's equity, it's all the same area, same amounts. And here's the statement of shareholders' equity. We will skip over that and come down to the statement of cash flows.
Now, the way the statement of cash flows work is that usually one of the first, this starts out with cash goes at the beginning of the year, but most cases you start out with net income. So basically it's net income plus or minus all these adjustments to come up with this increase in cash. And actually, when you look at it, if you remember right, back on the income statement, we mentioned that Apple had, oops, I went too far. Back on the income statement here, Apple had $39 billion of net income. But when you look at their change in cash, when I look at the balance sheet, they started out the year with $14 billion in cash, and cash actually went down to $13 billion. So some people would say, okay, how come? You made $39 billion of net income. How come your cash went down? The cash flow statement basically explains the change in cash. Starts out with net income. Here are all the different adjustments. And their cash did go down, so this is now their ending cash flow balance. Then you can scroll back up and say, well, what caused their cash to go down? Well, the biggest decrease in cash was this number right here. They spent $45 billion in buying back some of their own stock. They bought back some of their own stock, spent $45 billion, and that was one of the major draws on cash. Now, they did have some marketable securities they invested in and pulled out, which is up here, but the main outflow of cash was for repurchasing common stock. So by looking at the financial statements, it basically gives you an overview of the health of a company. You look at their income statement to see how profitable they are for the year, how well their company is running, their operations. Their balance sheet's kind of like their overall health. How much cash do they have on hand? How healthy are they financially? Cash flow statement helps explain where the cash went for the year. Income statement shows revenue and expenses for the year, but the cash flow shows the amount of cash and where it went for the year. And the statement of shareholders' equity would help you understand the changes of equity positions throughout the time period. So that's kind of an overview of the financial statements of a company. Hopefully that's helpful and gives you some background on financial statements, their layout, and what they're used for. Thanks.